Welcome back to the Explainer. Okay, so in our last module, we went deep into the theory. We walked through every single liability and equity line item and even broke down a plain language glossary of the key terms. Well, today, we're taking all of that foundational knowledge and we're finally moving from theory into practice. This is Module 5 of our ASC 200 balance sheet training, and we are basically going to create your ultimate zero-error playbook for the period end close. We've got a packed agenda today. We'll be hitting the 5 foundational rules, digging into some really common period end mistakes, looking out for the infamous covenant violation trap, establishing our key reconciliations, and finally, doing a retained earnings reality check.
Let's dive right into those foundational laws. These are the big ones, the 5 rules you literally must never break.
Right off the bat, we start with absolute authority. These rules apply every single time you build or review a balance sheet, no exceptions. So, rule number 1, the golden rule of accounting. It must balance, always. Total assets must equal total liabilities plus total equity. I know it sounds super basic, right? But listen, this isn't just a friendly guideline. It's a hard structural requirement. If it doesn't balance, you literally have to stop everything you're doing and find the error immediately. You should never, under any circumstances, present a broken balance sheet to management or to auditors. It's just a non-starter. Now, rules 2 and 3 kind of work hand in hand to form the core of your period end tasks. Rule 2 says that current versus non-current classifications have to be reassessed at every single balance sheet date. You can't just, lazily copy last period's classification without checking it. Why? Because maturities, restrictions, and business conditions change constantly. And while you're doing that, Rule 3 demands that every single line must be reconciled to source data. Every number needs to trace back to a supporting schedule, a subledger, or some kind of source document. No number gets to just exist on an island. It needs a paper trail, period. Moving on to Rule 4, which is all about protecting visibility into your liquidity. Basically, restricted cash has to be shown separately. If your company's cash is locked up, even just a portion of it, by a contract, a lender agreement, or some regulatory requirement, it demands its very own line item. You must never combine restricted cash with unrestricted cash. If you do, you're painting a completely false picture of how much money the company actually has available to spend. And trust me, nobody wants that surprise. And rounding out our top 5, Rule 5 requires you to show the prior period for a consistent comparison. Annual balance sheets always show the prior year side by side. But here's the catch. The absolute crucial point is consistency. If you change how you group or classify things this year, well, you actually have to go back and adjust the prior year to match. Any reclassifications from that prior year have to be fully disclosed in the notes. All right, so those are the unbreakable rules. But let's be real, even with those rules in place, accountants still step on landmines all the time. Let's navigate some of these common period end errors. Picture this. You roll forward last month's spreadsheet, you're rushing, and you totally forget that a chunk of cash was recently restricted. It happens way more than you'd think. Or consider blindly rolling forward your current and non-current splits without actually doing a mandatory reassessment. Another classic trap. Letting your accounting software automatically default your deferred tax assets into current assets. Just a quick reminder, deferred tax assets and liabilities are always non-current, period. Implementing really simple process updates, like keeping a dedicated restricted cash schedule and forcing a period-by-period reassessment, will save you from these massive audit-finding errors. Same goes for deferred revenue. Please don't just dump it all into the current bucket. Why? Because you might have delivery timelines stretching out way past 12 months. You've got to actively review each deferred revenue balance against its actual performance obligation date. You also can't just ignore uncollectible receivables. You have to run an accounts receivable aging report at every close and actually apply your allowance for doubtful debts. Oh, and for unrecorded liabilities, like when invoices haven't arrived yet and it causes a cutoff error, you absolutely must review your goods received not invoiced, or GRNI, before you close the period. Okay, we need to pause here and lower our tone for a second, because we have to talk about the absolute highest risk trap on the board. This is a massive, massive risk. If a debt covenant is violated and no qualifying waiver has been obtained, the entire loan balance must be reclassified to current. Let me repeat that. Not just the next installment, the entire thing. This usually happens when the team just forgets to run the covenant calculations, like, say, checking the debt-to-equity ratio at period close before classifying the debt. Missing this, it can literally destroy your reported working capital overnight by dragging years of long-term debt right into the current period. It's a single mistake that can trigger a cascade of severe consequences with your investors and regulators. So how do we avoid waking up in a cold sweat over these traps? We build a safety net, and we do that through bulletproof period end reconciliations. Like we said earlier, every number needs a paper trail.
But here's the rule. A reconciliation is not complete unless the difference is exactly zero and fully explained, or all the differences have been thoroughly investigated and cleared. Your asset lines require serious, rigorous cross-referencing. Cash and bank balances. They tie back to the bank statements plus a bank reconciliation work paper. Accounts receivable needs the subledger, the aging report, and the allowance schedule. Inventory means physical count sheets, costing records, and its subledger. And your property, plant, and equipment, that has to reconcile to the fixed asset register, capturing every single addition, disposal, and all the depreciation run for the specific period.
And hey, this strict matching principle, it absolutely applies to your liabilities too. Don't just glance at the subledger and call it a day. Your accounts payable has to trace back to actual supplier statement reconciliations. Your debt must tie perfectly back to foundational facility agreements, actual bank confirmations, and a meticulously updated debt maturity schedule so you nail that current versus non-current split. Finally, lease liabilities, they must reconcile directly to the specific amortization schedule for every single lease agreement.
Which brings us to one of my absolute favorite period-end tricks. I call it the retained earnings reality check. It is the ultimate mathematical proof. It's a simple but incredibly powerful mathematical flow to check your work at the very end of the process. To reconcile retained earnings, it's just 4 easy steps. Take your opening balance from the start of the period. Then, add this period's net income directly from your income statement. Next, subtract any dividends paid out. That simple formula must perfectly equal your closing retained earnings on the balance sheet.
But here's the kicker. Why is this check so vital? Well, if your calculated number doesn't match the closing balance, it is a massive red flag. It means something was posted directly to equity, completely bypassing the income statement. Now, sure, there are a few very specific, highly technical reasons that might be allowed under certain frameworks, but let's be honest, 99% of the time, it means someone made an erroneous manual journal entry that demands immediate investigation. It's basically the perfect diagnostic tool to run at the very end of your close.
Look, knowing these rules is one thing, but enforcing them, that's another beast entirely. It leaves us with a pretty provocative question. If auditors walked into your office tomorrow, are your internal controls actually robust enough to catch a manual equity entry or a missed debt covenant before it's too late? Well, that is exactly what we are going to uncover in our next and final module: audit, controls, and the period end checklist. You won't want to miss it. I'll see you there.